Good morning, everybody. Thank you so much for joining us today for August's version of Coffee with Forethought. Gonna give it just a second here to let people in. I was thinking about it this morning. It's a little funny, even though we're doing this virtually, you still got to wait for people to file in like it's like we're a live audience. But that is still today's technology. So before we get started here, just a quick disclosure now that hopefully most folks are in. Just remember that today is for informational purposes only. Please do not take anything that Jake or I say as personal investment advice. You can find our full disclosures on our website, and we encourage you to take a look at those if you get some time. For those of you who don't know me, my name is Joel Johnson. I am one of our two presenters today, and I am joined by our senior research analyst, Jake MacFarlane. And Jake, before we get started today and kind of go over our agenda, one of my absolute favorite things that we do here at FourThought, and one of my favorite things to do for coworkers, is to celebrate big wins. And with that, Jake had a big win in that he passed his CFP exam. So we could not be more proud of him. Big congratulations to you, sir. That is definitely not an easy thing to go through. I know you're still waiting on a few more requirements to officially call yourself a CFP, but the big part is out of the way. So could not be prouder of you. Congratulations on getting that passed.
Awesome, Joel. Appreciate you. Thank you so much.
Absolutely, absolutely. So just a quick reminder for all of our attendees, reach out to Jake and congratulate him too for me. We can't see you, so just send him your love and prayers for us. That'd be great. But we also are having a Q&A at the end of this presentation. So there is a Q&A box down at the bottom of your screen there. Feel free to type any questions that you have throughout the presentation. Jake and I will be monitoring those and hopefully get to as many of them as we can at the end of our talk today. If we cannot, we will make sure that we have somebody here at FourThought reach out to you and make sure that your question is answered. Again, just keep in mind, we cannot answer specific questions to your personal situation, but we'll make sure that we get as many questions as we can answered towards the end. So jumping into August's presentation, some key topics. Many of these we visited last year, so we want to revisit, or last month, so we want to make sure that we revisit today. We're going to review where the markets are now. Jake, I didn't see any headlines in July. Did you?
Oh, no, I think the market was asleep, maybe. There is nothing.
So we're going to review what all those headlines did to the markets, what we're seeing out there, kind of give you a recap of what happened back in July. We're going to touch on our holy grail, which you'll remember is our economic update, kind of the key indicators that we're looking at. A lot of economic data came out. One of the things that I promised at our last event was a recap of the One Big Beautiful Bill Act that recently passed. So that act passed after we did this last month. So we'll do a brief recap today. And then finally, we want to make sure that now we're out of earnings season and actually already moving into the next one, revisit some valuations and earnings results, and also what we might be able to expect for the next few months and what we're looking at from a research standpoint on the companies that we follow. So with all of that being said, let's go ahead and jump right in. July. Jake, what happened in July?
Yeah, now we're getting into the good stuff. And there's a lot that happened in July. And if we look at the left-hand chart here, this paints that picture. Looking at four major market indexes, we have the S&P 500, which was in purple. It did pretty well, up almost 2.5%. And looking at also the NASDAQ, those technology and growth companies within the US markets, that soared up over 4.5%. Just an incredible month. Now, taking a look at some of the other indexes that were actually in the red. And the one that sticks out to me would be in that light green. We have the international markets down almost 1.5%. And what's really interesting about this is, like, if you look at just a short-term results and any data point, right, Joel, you know this as well as anybody. We can make the data say exactly what we want it to say. And so right here we're saying that US stocks, growth stocks, are doing phenomenal, and international is back in the dumps again. Now, when you zoom out a little bit more, you can tell a different story, right? And that's what we see on the right-hand side. And that light green that did so bad last month is notably higher than the other lines there over the last year. And that really tells us what's happened on the last 12 months, widening out a little bit. International markets have done a lot better than the US markets. The dollar has weakened over that same time period. However, even in the midst of a lot of volatility that we saw in April, you see that the lines start to dip there. We've had a resilient comeback since that very, very short term dip that we saw. And the US markets have rebounded even a little bit better than the international markets did, even though international didn't fall quite as much.
Yeah, one of my favorite sayings, and it's kind of a nerdy analyst saying, is numbers don't lie, but they can't be manipulated. It's a great thing to point out, Jake. And I think the right-hand chart really is the one that I would focus most on. And it's been what we've been preaching to our clients over the last couple of months that we've been doing these is diversification matters. And so even though what we're not trying to do is chase performance, if we had, you would have been going heavy into international. A lot of our clients, we wanted to have some international. It varied client by client, but having that diversification has really, really helped. Now, of course, because most of our clients are US investors, what we tend to see is very domestic bias in portfolios. And by that, I mean we're very heavy typically in domestic stocks. And very typically, it's the larger big tech names just because they've outperformed so strong over really going on about 15 years now. And so that has performed well over the last month. International over the last 15 years hasn't done as well, but having that diversification over longer time horizons, again, manipulating those numbers, they don't lie, but they're manipulative. That's really been the most beneficial things for our clients. And that is definitely what we would be a proponent of moving forward as well. And now you mentioned a little bit there, you touched on the dollar. We're going to take a look at the yield curve in just a second. The one thing I did just want to point out on that left-handed chart there is that dip towards the end of the month. And of course, that was the tariff announcement. Tariffs still are the big outstanding boogeyman of the market, if you will. We just still have no idea where that is going to go and no idea where it's going to land. We've seen some big deals come in from different countries, which is a good thing. Politically, one way or the other, we're unbiased as to what that looks like for us as analysts. What it really comes down to is the market doesn't love uncertainty. And right now, that is probably the most uncertain of all of the economic things that can happen over the remainder of the year. It's probably got to be tariffs. And so
Great
let's
point. Yeah, and Joel, as we kind of transition into the next slide here, I think really as we talk about uncertainty, I agree with you. The tariffs is number one. I would say number two is probably what the Fed's going to do. And I think this slide right here shows us that dynamic pretty well. And if we look at the bond market, the treasury yield curve, we have three different lines here. And so that the yellow line, which is really the higher rates in the shorter term, right? That 1 month being at 5.5%. That was what we saw a year ago. And we highlighted this in our last month call. Like, this was not normal and it's not sustainable. That's an inverted yield curve where if you loan money out to your friend over a 1 month period at 5.5%, you would expect to earn a lot more than that loaning money to your friend out 30 years, right? That's a much longer time, a lot more risk. And we know that a dollar today is worth more than a dollar 30 years in the future. And that's not what we saw a year ago. We saw that 30-year treasuries were under 4.5%. And what we've seen transpire, and Joel, I'd love to get your comments on this too, but in my opinion, we're starting to get back to a more normal yield curve where the long end is coming up and the short end is coming down. But what I also see here is that we're still in a little bit of a wonky spot, looking at that blue line, which is where we're at today, in that the 1 month rate is still higher than like the 2-year rate and the 5-year rate and the 7-year. And so what that tells me, and also looking at futures markets, which is basically what investors are saying about what the Fed is going to do, is that the market's expecting about 2 rate cuts this year. And so that is kind of a lot. And right now the Fed has still been on a pause mode. And that's, I think, the other sort of risk out there is that, the Jerome Powell right now is in a tough spot where he's trying to figure out what tariffs are going to have for future inflation. And that's so
Mhm.
uncertain. And I don't know if we'll get two cuts. And Joel, just wanted to get your thoughts on this view here too.
Wholeheartedly agree. Yeah, if the Fed truly is data dependent, and we're going to jump into that on the next slide, then I think the data is kind of telling the mixed story. And so, if they're going to be predictors, which we all know that that's extremely hard to do, especially with all the uncertainty going on, then we might get to two rate cuts. But we're not economists, we're not trying to make predictions, but I would be shocked just based on the data that we've seen if that were to actually occur. The thing I think is important is that when most people think of the Fed and rate cuts, they tend to think of like their mortgage, right? They expect that if the Fed cuts a quarter point, then that means that the mortgage is going to go down from like where it is today at 6.5, 7, whatever it is. That's not actually the case. The Federal Reserve only has control over this short end of the yield curve, which is really only about, I mean, it's really not even that long. It's only the first couple time periods there. That's the only thing that they have effect on. The rest of it is completely market driven. And so it's a great point that you make, Jake, which is that even if they do cut, we don't know what that end of the curve is going to do, because if I'm lending you money for 30 years, I need to be extremely confident that you're going to give me that return back. And if I don't have that confidence, I'm not willing to, I'm going to be, I need a higher rate for that. And so that end of the yield curve, we just don't know what's going to happen to it. That front end, a little bit more insight. I'd be shocked if it's two, but I'd be pleasantly surprised. And just back to my mortgage comment real quick, just for those folks out there, very typically that's actually much more closely tied to the 10-year on this chart than it is the front end of the curve. And so when you're looking at mortgage rates, that's really the one that you want to track more than anything else. But again, even mortgage rates are market driven, not yield curve driven. So that's a really important distinction that I think is sometimes misconceived by folks. And so with all of that and with all of the uncertainty, let's talk about the economy and what that data is telling us, Jake. And when you look at this chart, there's actually quite a few changes from the last time we reviewed it. So
Yep.
what was the thing that stuck out most to you with all of the things that happened in July when we're looking at these indicators?
Right. So just as a reminder, we last month we actually had two of these indicators that were red, and so we see a little bit of a marginal improvement there, where those two were real GDP growth, and the second one was housing starts, and both of those have gone in a little bit of a positive direction to now be a yellow. So that's good. The flip side of that is we had some more that were green that turned yellow. Two of those flipped from green to yellow now. And that's retail sales and auto sales. And there's a lot to talk about here. So the thing that jumps out to me, I think, probably will start with GDP growth, Joel, because I think there's more to the story than what is on this chart. And we mentioned last month, or maybe even 2 months ago, that the Q1 real GDP was negative, and we talked
Mm-hmm.
about like, hey, don't really read too much into it because a lot of it has to do with trading power, trading dynamics due to tariffs. These tariffs were coming out, and what businesses did is they imported a lot of goods in excess, like in excess of what they needed, anticipating that tariffs would come. Now we've kind of seen the rubber band effect of that flipping, and actually the recent GDP number came in at plus 3%, one of the largest rebounds that we've had in a number of quarters. And actually net exports had the best ever recorded jump due to that rebounding effect. The other number that I will pick apart with GDP, and that's one thing about some of these indications is like oftentimes you don't really want to know how the sausage is made, like how GDP is calculated, and even like CPI. It gets real messy, and but if we look at GDP growth, one thing I always focus on is the health of the consumer, because we're such a consumption-based economy. And we actually did see a good bit of improvement here in the last quarter, where consumption increased by 1.4% versus last quarter, it had risen just 0.5%. So I think that the headline number of 3% is one that we should, again, largely ignore because we told you to ignore the bad Q1 print. A lot of that is just the trading dynamics from tariffs. But I do think a sticky point of that would be the positive nature of how the consumer went on in the last quarter. Now, Joel, there's a lot more we can talk about. What's one thing that stood out to you?
Yeah, I'll tack right onto that consumer comment with the one at the very bottom there, that loan delinquency rate. That's one I've been keeping a close eye on. We still have it in the green because what we tend to like to see is that below about 2%. And essentially what this is telling us is, are people still able to keep up with all those debt payments that we have? And I know most folks have heard the stories about credit card debt increasing, and we know auto loans are more expensive. So the debt is increasing on consumer balance sheets, but they've been able to keep up with it so far. But if you look at it compared to just a year ago, that's a significant increase. We're up over 30%. Now, on a percentage, on an absolute basis, we're at 1.6 versus 1.2. But if you look at the entirety of the economy and just what that means from a number standpoint, that's one that personally I'm really keeping a close eye on, because I think it goes right to your point about that consumer and how healthy they are. And the other one that I'm really keeping a close eye on right now is the labor market. Now we've got that one also, we've got that kind of at a yellow because we're still at about a 4.2% unemployment rate. We had a slightly higher number come out recently that was a preliminary number. So we'll see what happens. You see that we've actually stayed steady at 4.2, and I even had to triple check this that those numbers were right. But yes, 3 months ago we were at 4.2, and so were we a year ago. But again, anecdotally, this is just Joel's experience and not what we've seen in the numbers quite yet. I've been hearing more and more about large company layoffs. I mean, big chunks of company workforce is starting to get cut because, again, uncertainty. As a business owner, you want certainty in the markets, and we have some certainty as far as taxes go now, but we still have all of these other things floating out there that we just don't know where it's gonna land. And I think that's starting to have an impact. The problem is, and Jake, you know this as well as I do, that labor market number is a lagging indicator. So we're not going to know for quite a bit of time. I mean, it's not too long. It's a month or two before those numbers really start to flush out. But it's one of the things that I'm keeping an eye out for, to say, okay, if we start to see that increase a little bit more, I think it ties into the consumer. You're right, we're a consumption-based economy. If I'm looking at those two things, I'm seeing where those trends are going and keeping an eye on it. Those are the most important ones for me.
Yeah, and also I think that tacking onto the labor market, that's got big implications on what the Fed is going to actually be able to do. Because if you think
Absolutely.
about, that balancing effect of full steady employment and also steady prices too, whereas, if the labor market does start to show weakness, that might give the Fed more of a more wiggle room and if they want to reduce rates. But looking again at the inflation number here, we've got it in green. And one thing just to note that, like, inflation, it's just getting stickier here. And the Fed target is 2%. They're not budging on that. But one thing to note is that if you look at the 1 year number at 2.53%, if we look at that number 1 month ago, I just looked at it before our call here, and it was in the 2.38% range.
Mhm.
So that just a 1 month, that's a pretty large increase there in year over year inflation, and we're not going in the right direction. So I think that, again, along with the tariffs, is and not to harp on that, but really makes the Fed's job pretty tough.
Yeah, yeah. At the end of the day, wherever these tariffs do land out, it is a tax on the consumer one way or another. Again, completely apolitical comment there, whether you're for them or against them. Somebody's going to have to pay those. And that does. Now, the hope is, of course, it's a short-term inflationary bump, but you just never know with these things. So again, I did, I agree with you, Jake, and that's the tariffs being the outstanding item there. We just still don't know. But with that being said, one thing that we do know is we got some clarity as far as taxes go. So switching more over into the planning side of things here, talking about the One Big Beautiful Bill Act. When I say that, that is what the actual act is called. That is not a political comment either. That is what they actually wrote into the bill. So you'll remember quite a few years ago, over a decade ago now, we had Obamacare. That was a moniker. That was a nickname for the Affordable Care Act. That is not the case here. This was actually called the One Big Beautiful Bill Act. So bear with me when I say that. That is not a political comment in any way. So we did a full presentation. It was about a half an hour presentation going into more specifics here, but I promised it last month, so I'm bringing it back this month and thought I'd give just a quick 2 minute on what we saw in the One Big Beautiful Bill Act. So the big thing for everybody is that the tax regime that we've been under since the 2017 Tax Cuts and Jobs Act, tax rates have been made quote unquote permanent. And I say quote unquote because it's only as permanent as Congress is. And when another Congress comes in and wants to change it, they can. So it's not permanent, but for the foreseeable future, this is the law that we will be living under. That has been made permanent. That is generally speaking good news for everybody. Tax rates would have probably gone a little bit higher if that hadn't happened. The other thing that that did is also keep a larger estate exemption for folks. And so there's a slight bump in 2026. Now it's up to 15 million. That's for gifting and that sort of thing for planning clients. But those have all been extended or made permanent. The other thing that I wanted to point out that applies, I think, to pretty much everybody is there are new rules for charity. And so giving to charity has changed slightly, nothing major, I don't think, in my personal opinion. I'd highly encourage you to reach out to your planner to talk about any changes that would have happened for your plan. But basically, very high level, if you were itemizing deductions, there is now a minimum that you have to give to charity. And if you've been standard deduction when you're filing your taxes, there's now the ability to take some charitable deduction anyway without having to itemize. So good news for those folks. But again, for your specific situation, reach out to us. We're happy to talk through it. The itemized deduction cap, this one's a big one for my CPA and attorney friends out there, and of course, financial advisors. Unfortunately, our fees are still not tax deductible. That has been made permanent. So that's what I'm talking about there. And for my friends that live in the high taxable income for state tax states, so talking about New York, California, and such, the SALT deduction, the state and local tax deduction on tax returns, has actually been increased to $40,000. That is subject to some income limits, so keep that in mind. But that is good news for those folks. A little bit of reprieve there. It was at 10,000, now it's up to 40. Again, income dependent. So those were kind of the big takeaways for me. I'd highly encourage you, if you have the time, reach out to us for the link to our full presentation on the OBBBA. But for today, I think that's a good high-level overview. And again, I highly encourage you to reach out to your planner to talk through your specific situation and any planning opportunities, because there are some that might apply to you. So I got my planning itch taken care of, Jake. Let's jump right back to the economy here or the markets, and let's talk about the S&P 500, which this has been an ongoing discussion we've been having for, I can't even remember how long now.
No, absolutely. And even before I do that, I know we said like we're not going to make recommendations on here, but one recommendation I will give is to watch the video that Joel did on the One Big Beautiful Bill Act. I think it was really informative and would just encourage all clients, if you didn't listen in live, we'll make sure that we send that that presentation and link for that replay, because it's really, really well done.
Thanks for the plug.
Absolutely. No, but getting into the equity markets here, this really reminds me of, I know we had required reading, Joel, in high school. I don't know if you did that, or if you didn't do your homework there. Something tells me you were a pretty avid reader. I'm sure.
It was on tablets, but yeah, we eventually moved to paper.
There we go. But one that I know I read and lit was A Tale of Two Cities by Charles Dickens. And the iconic line is, "It was the best of times, it was the worst of times." And I think this pretty much captures this sort of strange duality of today's investment landscape. And so on one hand, we have Wall Street. Wall Street is very optimistic. The equity markets are soaring, especially post April. In fact, the Russell 1000 Growth Index rose 35% just since April through today. And I mean, that is just incredible. And we'll get into valuations here in this chart in a second. But I think the other side is that we have Main Street to think about too. And Main Street doesn't feel the same way. And what I mean by that is looking at consumer sentiment, we're still very low there. If you talk to the average investor, they don't feel very good about the economy and about the markets right now, which I think is a little bit against how portfolios are being positioned right now, and taking maybe a little bit more risk than what we would like to see for the normal investor. But also, we talked about inflation still being a persistent concern, and monetary policy is still restrictive, and that the Fed is keeping rates pretty high relative to what we've experienced recently. And so what this does is it causes stress on, number one, home buyers, for example, or really any sort of borrowers. It could be for, if you want to go and get a new car. And we looked at auto sales are not doing so well. That was one of the holy grails that was in the yellow. Also small businesses too. And there's just a lot of uncertainty there from tariffs, from inflation, and also from high rates. So there's that like juxtaposition that just doesn't really align. And I think when we look at where the market is from valuations and from concentration, we're seeing a little bit more risk, I think, than a lot of us would be super comfortable with. So on the left-hand side, we look at the price to earnings, or the valuation of not only the S&P 500 overall, but it breaks it down between the top 10 and also the remaining 490 names in that index. And just a reminder, your top 10 names, a lot of these are like growth stocks. A lot of them are in tech or tech adjacent markets. So you have Nvidia and Microsoft. Those two alone make up almost 15% of the entire index. Then Apple, Amazon, Alphabet, which is Google, Meta, a lot of these names here. And what we see is that, just full stop, the market is relatively expensive. It trades at 22 times earnings, which is a 32% premium than the long-term average, which is around 17 times earnings. But to me, what's a little bit even more concerning is we have seen expensive markets since COVID, and a lot of it had been driven by those top 10 names being outsized in their premium to the historic multiple where they usually trade at. What's a little bit more concerning to me is that the remaining stocks, the other 490 names, are expensive now too. They trade at almost 21 times earnings, which is a 31% premium to their long-term average. The second part of this whole equation is that the market's getting exceedingly concentrated. Being the S&P 500 is a market cap weighted index. So the larger companies within the index get a larger piece of the overall pie. And right now, if you invested $100 in the S&P 500, $38 would go to those top 10 names, which are innately going to be growth companies that operate in technology and are heavily correlated with one another. In other words, if Nvidia has some bad news or there's some slowdown with semiconductors, that's going to impact most of the other 10 names in that top 10 to a larger degree than if there was some more diversification in different sectors and types of companies there. So I think what I'm painting is that, number one, these top 10 companies, they are growing extremely well. And we'll get into a couple of them having recent earnings, but the margins are great. The growth has been really great, but it's just expensive right now. And what that tells me is that the market is expecting this growth to continue or maybe even pick up in the near future. And with the risks that we presented, it doesn't seem like such a great trade-off. Not to say that, you got to get out of these names, but these are just some risks that are building up within the equity market right now.
Yeah, all great points, Jake. I couldn't agree with you more wholeheartedly. I want to make 2 points on all of that. The first one being that when folks say that the market is expensive, they tend to talk about the S&P. And you pointed out some great reasons that it is expensive. And most of it is driven by those weightings, right? Because you have a higher weighting, that's going to drive the higher multiple, which is historically more expensive. And remember, numbers don't lie, but they can be manipulated. And so when you look at it, the market overall is expensive, but you pointed it out perfectly. Those other ones are as well, but there's a lot of tech in those too. And I think right now, kind of point number two, the market is so excited because you could not wag a stick at an earnings call over the last 6 months without a CEO or some other executive mentioning the letters A and I about 400 times in an earnings call that lasts about 45 minutes. And what I think a lot of investors are hoping for right now is that that is going to drive a lot of efficiencies for these companies. And I know we're going to talk about some specific ones in a minute. But if that doesn't come to fruition, or if something changes in that, or if it doesn't impact all companies the same, that's going to drive a lot of market volatility that we might see moving forward. So something to keep an eye on. And I want to go back to your point. When we talk about this, and like I said, we've been talking about this for years now, it does not mean we are not staying invested. Staying invested is still the best thing that you as an investor can do. We are not timing the market. We are not trying to move in and out based off of valuations. What we're trying to do is using sound fundamental portfolio management principles, working with Jake and I to make sure that you understand the risks that you're taking with the dollars that you have. And I think right now you pointed it out well. One of the hidden ones is by just even owning the S&P 500. As long as it keeps working, it's going to keep working, right? Until it doesn't. When it doesn't, those top 10 names are going to drive most of the underperformance in a down market, and you're going to have significant exposure to those. Not a good thing, not a bad thing. There's portfolio management conversations to be had. We want you to understand what those risks are. And then again, from the planning perspective, make sure that your long-term plan can handle those risks. And if they can't, then we make changes. But just based off of looking at things like this, we're not making broad changes to our portfolio. So great points. Just wanted to point that out. Anything else to add before we move into some earnings here, Jake?
I think you summed it up great. I mean, it's a time to have diligence, to have discipline, and also a thoughtful allocation, right? Not just in the names that have done well. We talk about diversification all the time, and I think now is a great time to really look at the other asset classes, fixed income, et cetera, making sure that the portfolio is well balanced and that the risk profile of your portfolio aligns with the risk tolerance that you have as well, and meeting your individual goals and objectives. And that's what the planners here really do a great job with, helping define that and stay within those parameters. But Joel, let's get into some of the exciting stuff, some of the earnings. And my
It's
goodness, it
exciting
seems
for
like
you and me.
what's that?
It's exciting for you and me.
Yes, yes, for us. I mean, nobody else, but us. And it seems like we were just in earnings season, and we stepped out of it for about, I don't know, 2 seconds, and now we're back in it again. So we started to see a couple companies report here, and we've got a little bit of like the good, the bad, the ugly. But I think looking at some big tech names, and I've listed two here that are we follow these names very, very closely, and that's Microsoft and Meta. And both of them had great earnings results in their own rights. As Joel noted, AI is used in every single company's earnings call and transcripts. But these are two companies that are really executing on AI, and it's generating not only revenue, but also operating profit. So just looking at Microsoft, for example, they had positive revenue and positive earnings surprise. Revenue was up almost 20% year over year. But I think kind of the most staggering numbers came from Azure. And that's their cloud, right? Microsoft's cloud infrastructure. And what we saw here was better than expected growth, but it came in at 39%. And keep in mind, Azure, the revenue that they generate from Azure annually is $75 billion. That is enormous to be growing at that rate. It's actually staggering. And not to pick on another company, because as Joel mentioned, right, numbers don't lie, but we can use them to manipulate, right? Um, and I will do that right now with a company like Palantir, right? They're one that has been in the headlines all over the place, and the stock has done phenomenal. They are kind of an interesting example to use because they're actually in the top 20 now of market cap in the United States. And they, as a company, have made under $4 billion in the last 12 months in revenue. So just comparing the scale of Azure to a company like Palantir, which is doing phenomenal, the stock's doing phenomenal. I think it kind of puts that in perspective of how well they're executing there, and I think they beat the expectations by almost 400 basis points, which is really phenomenal. Looking at Meta platforms, this is one too where they had an even larger beat on earnings and on revenue. They also raised their guidance for 2025. What we're seeing here is that the advertising dollars that Meta is able to continually rake in has done exceedingly well. And what management is kind of saying is they're using that kind of cash cow, profitable business to continue to make further investments in AI. So it looks like the capital expenditures that these large companies are making towards AI is not going away anytime, which should bode well for some of those, semiconductor names.
Mm-hmm.
Now, on the flip side, we have a company like PayPal, which I think if you segment it out into the good, the bad, the ugly, there wasn't a lot of bad and ugly for Microsoft and Meta, but there is some for PayPal. The stock was down around 8% after earnings. They had definitely some good things happen in their earnings call over the last quarter, such as revenue and earnings both beat expectations. And they had a lot of good happen, such as like partnerships. For example, they partnered with the Big 12 and trying to get those students to use like Venmo more and things like that. They also saw Venmo's margin and revenue increase a lot more than they expected. So that's a big business of theirs that they haven't been able to monetize effectively. And they're starting to maybe gain a little bit of traction there. But the bad, and this is what the street was focused on, is something called branded payments for PayPal. And that's when, you go to a store and you actually click the pay with PayPal button. That's what they call branded payments. And they're able to get greater margins on branded payments. And that has been an area where they have struggled to sort of revamp that engine on. And that's what the street and investors were ultimately focused on. And that's what led the stock to drop post earnings. And we're not slowing down. I mean, next month we might have to have 2 slides on earnings spotlight, because just in this week we have major companies reporting earnings. Looking at healthcare, we have Novo Nordisk and Eli Lilly, 2 behemoths going at each other, especially in the GLP department. Also, Zoetis reported today. On technology, we have AMD and FourThought, as well as on the consumer side, Mercado Libre, which is the Amazon of South America. So yeah, we're just getting started here, and it's really tough to make kind of wholesale judgments based on just a few companies that have reported. We're certainly still seeing buzzwords like AI and tariffs being used quite frequently. However, we did, start to see some positive results from these big tech companies that could hopefully, reach into the other big tech names that are kind of frequently owned in our portfolios here.
Yeah, and Jake, I know me and all the other planners, we don't do these earnings reports on a day-to-day basis, and we really appreciate the work you put into it, because we are fundamental investors at heart. So we care about the numbers, we care about the earnings, and we care about doing this type of research on the names that we like to put into client portfolios. We like to know what we own. And so you got a little bit of breathing room there. So I hope you enjoyed your 2 days off and right back into it for this coming earnings season. And so with all of that, folks, thank you so much for joining us today. We're going to flip on over to our Q&A session. If you don't join us for that, just a reminder, if you have any questions, please feel free to reach out to any one of us, Jake, myself, or any of the other planners here at FourThought. We're happy to answer questions for you. And if you know somebody who you think this might be helpful for, whether it's financial planning or even their investment portfolio, or you've had some conversations about some headlines and you think they might benefit from a third opinion, we'd love to talk with them. And we look forward to seeing you again next month, and we will move to the Q&A at this time. All right, everybody. Thank you so much for joining us. And moving over to the Q&A, Jake, right before we hop into it, just a quick addition. We are going to provide replay links and a link to our YouTube as well, where you can watch our previous presentations, the One Big Beautiful Bill. And then I know that you and Scott did a great economic update webinar recently as well. So we're going to make sure to include both of those links with our follow-up email. And you'll notice down at the bottom, we do have a handout for you to take with you today, just a very brief high-level summary of some of the changes from the One Big Beautiful Bill Act. And so please feel free to download and take that with you. Now, you still have time to get those questions in down there at the bottom, that Q&A tab, but we did have a few come in today. And Jake, I'm going to throw the first one to you. We spent a lot of time today in our presentation talking about earnings, talking about markets and what we've seen and kind of where we are valuation-wise. Given all of that commentary that we just had, have we been making broadly in our client portfolios any tactical decisions between growth and value?
Yeah, excellent question. I think when I go back to like our investment philosophy and our process, one of our largest focus is around cash flow, and especially like dividends as well. So that sort of positions us to innately avoid some of those maybe high flyer companies that don't really have profits and are a long ways out from ever paying a dividend. So if you look at our portfolios broadly versus like something like the S&P 500, let's just say, we're still gonna own those well-established blue chip growth companies like Amazon, Microsoft, Nvidia. And even if they don't pay a dividend, maybe they won't go in our dividend focused strategy, but they'll be in our core equity approach. But a great portion of that is like blue chip names that are paying and growing their dividends each year. We have a requirement that those names have to grow the dividend each year for 5 years at least in order for us to even look at them. So broadly speaking, we are going to be more defensive than kind of your standard S&P 500-esque index. That said, we have tactically shifted this year, kind of in different avenues. I would say we've added some more international names to our portfolios. A lot of these names are global businesses that have very strong dividends, and they're trading at generally lower valuations than the US counterparts. So that's where we've made switches, but you'll kind of notice with our process and our long-term fundamental nature of investing is that we're not going to take big bets on any, in any short-term like environment like this. But at the margin, we will, you'll see us trimming back on some of those growth companies, adding to more defensive value stocks in periods like this.
And tacking right onto that, I just had a question come in and works perfectly with that whole discussion, which is essentially, if the S&P is quote unquote overpriced, is there a way to invest in a broad sense, targeting those lower PE companies?
Yeah, absolutely. When somebody says a stock market, right, typically they're referring to the S&P 500, but there are so many different indexes and different ETFs or funds that have different objectives and goals. And so one example is like a strategy that we manage in here, right, for clients. A lot of you have probably heard of Income Opportunities Global, right? So that's our dividend growth strategy. A lot of clients here have it. That right there again is a defensive portfolio, and those companies generally have lower PE multiples than like the S&P 500. So that's one avenue. But if you were just looking at like a broad index, right, to do that, you could look at something like the Russell 1000 Value Index. And so what that does is it basically takes the Russell 1000, which is 1,000 large businesses in the United States, and it's going to actually like filter and invest in roughly like the 500 of those that have a low usually they use like other valuation multiples alongside PE, like price to book, price to cash flow, even. So there are certainly different indexes that have those type of profiles, but also there's different risks that come alongside there too. So would just encourage you to, any clients who are thinking about that, just talk to your planner and take a look at your portfolio alongside your goals.
Yeah, and I think just to add to that, when we talk about the S&P 500, you're right. That's what most people think of, and we mentioned it in the today also, which was it's market cap weighted. The larger the company, the larger the position in that index, just by the way that it's structured. Like you mentioned just now, there are so many ETFs out there. I think we're losing count at this point. There are some that take that philosophy and say, we're not going to do that, like an equal weighted S&P 500. So you own the exact same number of companies, but rather than weighting NVIDIA based off of its size, you just own it as an equal portion of all 500 companies. So there's so many different options, value versus growth, equal weight versus market cap weight. But yes, there are ways to invest that way. And you want to
Yeah,
throw the next
I saw
one?
another question come in. That's really around like dividends. We talk a lot about like earnings growth, revenue growth, but a lot of our clients are really focused on like the cash flow that's coming in. Joel, I'll start with you. Any thoughts around that, and then I've got my own thoughts too.
Yeah, absolutely. When it comes to dividends, one of the things that we particularly look for is that A, they prioritize them, and then B, that they're growing them. Really, the only time in recently that we haven't seen these companies growing their dividend was back during the COVID pandemic. Generally speaking, that was just because nobody knew what was going to happen. And so they held off for some time, some cut dividends, but for the most part, they at least maintained them, broadly speaking, and they've been growing them ever since. And we see them continuing to do that. The growth of the dividends have come down slightly as we have more uncertainty in the market, but generally speaking, they're still moving forward. And I'll throw it to you, and then I'm going to tie that to another question we had about nuclear stocks. Once you've given your thoughts to that.
No, that's fantastic. And like looking at the S&P 500, as we talked about, as it's gotten more and more expensive, right? The dividends of the companies in that index, right? They haven't quite kept up with the earnings and certainly with their stock price. So the dividend yield of the S&P 500 right now is like under 1.5%. I mean, I haven't looked at that, over history, but that seems extremely low. And so, how we take a different approach there is, we're not gonna, for the most part, in our dividend strategy, we're not gonna even look at names who don't pay a dividend or haven't increased it. But as Joel mentioned, some of the dividends have slowed down in their annual year-over-year increases. But if you look at like, you got to look at the different types of companies. Microsoft, for example, doesn't have a very high dividend yield because it's using the cash flow to reinvest in its business, which, like we mentioned, Azure growing at 40%, that's a very profitable IRR for shareholders. But they are also have been growing their dividend each year, and over the last 12 months, it's grown by over 10%. So, truly that organic kind of cash flow growth that we're looking for with the dividend companies is still maintaining at a pretty attractive rate. But again, it varies by company and by sector, of course, too.
And for those playing financial jargon at home, if you've got your bingo cards out, IRR, internal rate of return, it's just another way of measuring return for companies. But tying that into, we did have a question come in about nuclear stocks, and nuclear's definitely been in the news about a potential increase, a potential way to create clean energy and help with all of the new requirements that we're putting on the power grid. And the power grid's eventually going to have to start keeping up with this if we're talking about electric vehicles, AI, crypto, all of those big power sucks on the grid. And so we're looking at ways to keep up with that. Nuclear's definitely been one of the options there that most people have talked about. And we do keep track of these. The thing I would say is, ironically, or maybe not surprisingly, a lot of the largest utility companies out there. So I'm thinking of like a Nextera Energy, which is one of our long-tracked stocks that we have. They do have a nuclear component to their business that they've been working on. And so we don't have any direct nuclear companies that we track on a regular basis yet. Not to say that they won't start hitting our screens and start being included in that regular process, but through these larger utility companies that we do own, that we have faith in, and that meet the metrics that we require them to meet, we are getting some of that exposure. But it's again, it's not in that direct sense where we're owning a nuclear ETF or anything like that. So we do have the exposure. Again, there's so many different ways to play that, but we're focusing much more on the larger utilities than any direct bets in that space. And so with that, we are a little bit over our time. We try to keep this to about 45 minutes. We ran a little bit over today, but we had some really good questions coming in. I've got a couple more on my screen here that we will make sure that we reach out and talk to you about. So if we didn't get to you, we're not ignoring you. We just want to make sure that we're cognizant of everybody's time here. So thank you everybody so much for joining us today. Jake, any final thoughts before we part ways?
No, just appreciate all the confidence, and if there's anything that we said here that you want us to dig in deeper on, or just have a call and reevaluate your portfolio and how it's done, just encourage all clients reach out to myself, Joel, or your financial planner.
Absolutely. Thank you everybody so much. We will see you again next month.